Hello and welcome to Follow the Money. I am Su Jin Kim. Join us as we explore the tools and insights you need to jumpstart your financial journey. Philippine economy grew 5.4% in the first quarter of 2025. But is that fast enough when the national government debt has reached a record 16.7 trillion pesos and the budget deficit continues to widen? We break down what's driving growth, what's dragging it down, and what it means for every Filipino. Helping us navigate these complex economic signals is one of the most trusted voices in finance and economics, Chief Economist of RCBC, Mr. Michael Ricafort. Good afternoon, Mike, and welcome to Follow the Money.
Hi, good afternoon, Su Jin, and dear viewers. Nice to be back.
Let's get started. The PSA data in Q1 was slightly above the previous quarter, but significantly lower than the same period last year. What were the drivers behind the slowdown, and do you see this trend continuing in the next half of the year?
Well, Su Jin, we have seen, based on industry origin, slowdown in the growth in services and in the industrial sector. However, agriculture, it improved a bit, although the growth is still modest at a little over 2%. But based on expenditure share, well, we have seen, still decent growth in consumer spending, as well as the sharp growth in government spending, including infrastructure. The only thing that dragged the growth, well, we have seen some modest growth in investments at around 4%, at low single-digit levels, and more importantly, on the external side, external trade, we have seen slower growth in exports, and the faster growth in imports was also a drag on GDP growth because instead of purchasing or producing locally, so it went to, well, whenever there's a pickup in importation, the growth effectively goes to from the country that sold to us, and this may have to do with some tentativeness in view of Trump's reciprocal tariffs, some cautiousness, so to speak, especially on the export sector, because the U.S. accounts for 17% of the country's exports. That's the biggest destination for Philippine exports, and the reciprocal tariffs would effectively slow down the demand for exports, and that has been a drag. The reciprocal tariffs only happened on April 2, although Trump paused it for 90 days. It's April 9. Now everybody else except for China at a baseline tariff of 10%. So by the second quarter, we may see some, the effects of the tariffs when it comes to exports again and the overall global trade.
So, Mike, talking about the trade tensions because of the tariffs, how might these geopolitical frictions influence the Philippines' trade performance?
Well, yeah, true, because, the dynamics in the global trade, even to start with, even before Trump, there's already some slowdown in China, say over the past year or two. And China is the second biggest economy of the world. And now with we have seen very high tariffs set by the U.S. on China, by Trump. It's 145%. So, so the tax itself, it's already 145% for Chinese exports to the U.S. So the tax is more expensive than the cost of the product itself. For instance, a $1,000 worth of phone from China the tax for which is already 1,450, and the effective selling rate, including that tariff, would be 2,450 from just 1,000. So it's more than double. So imagine many other products. So what would happen? Exporters would be hit. There's a varying tariff rates for different countries depending on the negotiations, and the decision points would be kind of varied. It's still uncertain how Trump would decide on it. Would he maintain the reciprocal tariff? Would he reduce it depending on the negotiation? And Trump already mentioned that that it depends on him, regardless of the negotiation. It's really up to him
And
to
then,
decide.
Mike, going back to GDP, we missed our growth targets last year, though it was already revised downward. The government ambitiously aimed for 6 to 8% initially until it was brought down to 6 to 7%, still a miss. How does this performance compare with our growth targets or our regional peers?
Well, the Philippines is still among the fastest growing countries, Sujin. That's a well, at least that is still important to note because everybody else would slow down. Many export-oriented economies, especially our neighboring countries, a lot of them are export-oriented, like Thailand, Vietnam, Malaysia, and the likes of China, Taiwan, Japan. So it's a well, despite the slowdown, we're still one of the fastest growing economies, say at a little over 5%. Let's see in the coming months. We have yet to see the full effects of the midterm election spending on the GDP growth, but that's already manifested for the first quarter. Nearly 20% growth in government spending. So we'll see by the second quarter if we already see well we have seen we will be seeing the full extent of the campaign towards well right before the elections, spending by the candidates, by the donors, and uh, well those businesses and industries that are positively affected by it, and of course before the election ban, trying to complete as many government projects, but there are still those government projects that are exempt from the election ban, like some of the infrastructure projects. So that would be the growth driver here in the Philippines.
And
And
then, Mike, household consumption remains to be the largest contributor to GDP growth at 3.9%, with easing food inflation playing a significant role. How sustainable is this domestic demand, considering external uncertainties?
true, Sujin. The consumer spending is at least 70% of the Philippine economy. And there's still at least employment data is still among the best in about 20 years since revised records started in 2005. Meaning to say that unemployment rate at 3.9%, that's still among the best based on well based on the local records. The lowest was 3.1%, and we're already moving in line with more developed ASEAN and Asian countries. Meaning to say that would still be a strong pillar for consumer spending. And the Philippines is kind of insulated because our exports, Philippine exports, are like 3 to 5 times smaller compared to our neighboring, more developed ASEAN neighbors. No? So, meaning to say, their exports are 3 to 5 times higher than us, the merchandise or the goods exports. So, we're not too, well, at least the Philippine economy is not as adversely affected as theirs, no? Because it would really have a hit on many export oriented countries with the tariffs and other protectionist measures by Trump. So, and we're our exports are services. Like for instance, if you look at our major sources of dollar revenue, our OFW remittances, that's about $40 billion per year. That's not covered by those tariffs. So we're number 4 in the world after India, China, and Mexico, and we're the biggest source of nurses, at least 20% in the world, and we're also the biggest source of seafarers, that's 20 to 25%. So that's one. And secondly, BPO revenues, that's expected to reach $40 billion this year, and that's not covered by the tariffs. So we're kind of insulated with this services exports, and we're number 2 in the world for BPO after India, and for contact center or call center, customer service, that's 70 to 80% of total BPO. We're number 1. Even India cannot beat us on that leading position of the Philippines for a very long time because of and that would help us. Well, the Philippines, at least that's one of the resilient sectors. And the third source of foreign exchange is tourism receipts. That's $13 billion. It's a record high last year. Our neighboring countries here in ASEAN are 3 to 5 times higher than us. So that's a low-hanging fruit. There's a there's a great room for our foreign tourist revenues and numbers to grow further. Especially, this would be a function of further developing infrastructure like airports, the train system, the subway that would eventually connect to the airport, the train systems, the other mass transport system, and modernization of many airports, seaports, and other facilities that would help attract more tourists and foreign investment. So, yeah, hopefully that would insulate us from this trade wars, and that would continue to support consumer spending. And Well, because the Philippines is largely a domestically driven economy, so to speak.
And then, Mike, earlier today, DepDev Undersecretary Rosemary Adelion mentioned the need for deeper capital markets to boost investments. How can the Philippines attract more long-term capital, and what structural reforms are still lacking, you think?
Well, for capital markets, yeah, there's still room for the Philippines to also catch up because you know, attracting more capital to finance more businesses, conglomerates, and even infrastructure, the large infrastructure projects to get more money from overseas and flow them here, more investments. Well, essentially, it's really on the fundamentals. Bottom line is for these foreign investors, whether it's portfolio investments and also the FDIs, if they, well, if it becomes more profitable for them to invest here in the country. And for the FDIs, of course, it's really bringing down the cost of power. And, it's really the competitiveness by harnessing technology, because technology is the biggest equalizer eventually, like boosting the productivity for manufacturing. And that could be also be addressed by using the best technologies that's available, and also facilitated by technology transfers as the big foreign direct investments come in, like for instance high-tech industries and some of the dominant players in various industries, including in agriculture. They bring in the automated processes here, bring and of course technologies that would boost productivity, output. It's increased mechanization, higher yielding varieties, and the use of the cold storage facilities, and also irrigation facilities for the crops, and the use of the best technologies that's available worldwide. Actually, there's already a big private conglomerate investing in the agriculture sector for vegetables using greenhouses, the best technologies that's used in countries like Israel. So, yeah, it's a matter of, the Philippines is, our population is 12th largest in the world. It's a huge market. For global companies, if they want to be part of the action, they want organic growth, they must be here because, the biggest automaker, for instance, there's global sales. You know what's the ranking of the Philippines? The Philippines is number 10 in the world in terms of their global sales. So number 10. For a large multinational company, their sales here in the Philippines is also the 10th largest in the world.
We were talking about how the trade deficit insulated us from the impacts of Trump tariffs. And exports grew 6.2%, imports surged 9.9%, widening the trade deficit. Do you think the government should address this imbalance? And what would help improve export competitiveness?
Well, the Philippines is a net importing country because of the various free trade agreements that we have seen over the past 10 to 15 years. We have the free trade agreement with ASEAN, with China. So practically no more import taxes or tariffs. No? Maybe except for rice at 15%. It was already reduced from 35% since July of last year. And sugar at 5%. But other than that, no more tariffs. That's why, around 20 to 25 years ago, our trade deficit was just 5 billion. Last year, it's around 54 billion. In 2023, it was 52 billion. The record high was like in 2022 at 57 billion. Uh, well, we have seen well, that's also reflective of, the increased prosperity, the, increased fortunes of the country, the fast-growing economy that's requiring more importation. But the thing is, one way to really narrow that budget, that trade deficit rather, would be to, for instance, in agriculture, uh, well, to increase the competitiveness through mechanization, increase mechanization, the higher yielding seeds, as we mentioned a while ago, and the cold storage facilities, enable to, bottom line, there's to boost the output by using technology, reducing the cost at the same time. So it's a win-win. Farmers, it would become more profitable for the farmers, given by the use of those technologies. You have more production per hectare at a lower cost, and it's a win-win also for the country because it would entail lower prices. And that's one on the agricultural sector because the agriculture sector employs about at least 20% of our total workers. But despite that, based on the national accounts that came out this morning, agriculture only contributes less than 9% of the Philippine economy. So there's that mismatch in terms of productivity. So therefore, what would bridge that gap would be technology. The best technologies around that's already spearheaded by some in the private sector,
There you
both
have
local
it.
and foreign business.
Technology is the best equalizer. The economy is expanding, but so is our debt. What measures should be taken to keep this ratio in check? Follow the Money will take a short break. Stay with us. Welcome back to Follow the Money. We're still with RCBC Chief Economist Michael Ricafort as we zoom in on the risk signals. Is the government living beyond its means, and what are the long-term consequences? Mike, with government spending up 18.7%, how much of the debt growth is debt-driven, or the GDP growth is debt-driven?
True, Su Jin, that we have seen the widest budget deficit in for the month of March. That's the third largest on record. Meaning to say, we have seen a significant increase in government spending. Although we already saw some decent growth in government revenue collections, particularly BIR tax collections and Bureau of Customs revenue collections, because these are the lifeblood of the Philippines, are the major source of income for the Philippine government, the tax collections by the BIR and the Bureau of Customs. So what's really key here is that, first, we need to take cognizance of the fact that the Philippines borrowed heavily during the pandemic, especially from 2021, 2020, 2021, 2022. It was like around 2 trillion pesos worth of debt at the height of the pandemic in those 3 years per year, 2 trillion per year. So the debt to GDP ratio now is at 62%. It went up from 60.7% in the fourth quarter. And, that's the international standard is 60%. What's really important is to bring it down to below the international threshold of 60% to make debt management and overall fiscal management sustainable over the long term and for the coming generations, meaning to say the country would enjoy the relatively favorable credit ratings of 1 to 3 notches above the minimum investment grade. And that has been maintained since the pandemic, at the very least. And, it's better to bring it down eventually. So there are major ways to do it is, of course, you broaden the denominator, the GDP base. So we have seen some slowdown, some softer GDP data of late. Hopefully in the coming quarters, it would pick up again, and that would effectively help bring down the said debt to GDP ratio. That's one. And of course, another on the numerator side would be intensified tax collections by the BIR and the Bureau of Customs, meaning to say it's strict enforcement based on existing laws, run after the tax cheats, and of course, strictly enforcing. We have seen that in the previous three administrations, quite a good record for three different economic teams during those times over the past 20 years. Also, more disciplined spending, anti-wastage, anti-leakage, anti-corruption measures. It all starts and ends with good governance. And, it's really that determination to be strict about it, improving the structural earnings of the government, the structural through the tax collections, and of course, it would still be assessed eventually if there would be a need to eventually increase the structural sources of tax revenues, the lifeblood of the government, for instance. In view of the rapidly changing technology, increase online businesses, eventually the shift towards equalizing the taxation for traditional physical businesses and those in the online and digital channels. We have seen that already in the new taxes imposed on the foreign digital service providers. And because, there's an increasing share already in the economy of digital or online transactions. So there's a need to adapt that, say, from the physical store, and at the same time making sure that they're of equal footing, a level playing field when it comes to taxation. No arbitrage or no unfair treatment at that. And that's one. But there would be some proposed tax reform measures if needed. We have seen that over the past 20 years. 20 years ago, the debt to GDP ratio was more than 70%, but it was successfully brought down to as low as 39.6% prior to the pandemic, end of 2019. And, the country earned the first ever investment grade rating in 2013, and followed by subsequent upgrades on the credit ratings of the country until what we saw now at 1 to 3 notches above the minimum investment grade. So that's why it's very important to maintain that kind of the determination and discipline, as we have seen over the past 20 years. The last resort would be new taxes. Of course, that's not popular. Elections just around the corner. But at some point, if needed, that would be part of the considerations. It would be new taxes, higher tax rates, but as we mentioned, that would be the final resort if all else is still not enough to really narrow the budget deficit of the government, and at the same time curb the growth in the debt. And that's clearly manifested, the most important metric to make it apples to apples with the rest of the world, the debt to GDP ratio, which is now at 62%. So, that's a key metric. We have to look at that. With all those tax and fiscal reform measures, based on existing laws, eventually if that's brought down to below 60% international threshold, well and good. But for now, it's still a challenge because, there's a need to, some of the debts incurred during the pandemic, some of them already being serviced, principal matured, interest payments being made. We know for a fact that interest rates have gone up over the past 2 to 3 years, but it's slowly being reduced by the central banks around the world, by the Fed, by the BSP. So hopefully interest rates will go up, interest rate costs would go down, and at least the peso is now a bit stronger. The strongest in about a year at 55 levels from 59. So that would also help in reducing the peso equivalent of the foreign debts, as well as the servicing of which, both principal and interest.
Indeed, taxation should be the last resort in earning revenues. That's all the time we have for today. Thank you so much for your data-driven insights, our CBC Chief Economist, Michael Ricafort.
Thank you so much, Su Jin, and your viewers, and have a pleasant afternoon, everyone.
before we go, a reminder from Nobel Prize-winning economist and former chief economist of the World Bank, Joseph Stiglitz. GDP is not the ultimate measure of economic health. It tells you how fast you're moving, not whether you're going in the right direction. And that's it for today's edition of Follow the Money. I am Su Jin Kim. Thanks for watching. Keep it here on BNC, the Bilyonaryo News channel, always on top.